You said it looks a lot like the 1940s. Maybe talk a little bit just about what was happening in the 40s and the 70s that you see a lot of similarities.
Those were the two inflationary decades of the past century in the United States. In the 1970s, that's what a lot of people think of as the inflationary decade, but it's actually a somewhat less viable example here. It has some overlap, obviously. So in the 70s, debt as a percentage of GDP at that point was very low. They had already inflated away a lot of debt from the 40s, 50s. And so actually, public debt as a percentage of GDP was something like 30%. Private debt wasn't that bad either. And so overall, you had a pretty low debt environment, but you had other issues, obviously. So basically, they had, spent decades drawing down their gold reserves to support the Bretton Woods system, which is what the dollar was pegged to gold, and they couldn't really back that anymore. And two, U.S. oil production peaked in 1970, representing a real world constraint. They had to import more of their oil. Basically, you had this combined scenario where they went off the gold standard, so that broke the money system, and then they actually had that inflationary component of oil restrictions, and then also there were geopolitical issues, obviously, in the Middle East. And so for a while, that was a very inflationary period. And as you can see on the chart there, the Fed kept trying to raise interest rates to combat inflation. But they were generally, they weren't decisive with it. They were slow. They kept saying it's transitory. Sounds familiar. And so they fought this for a while. And it wasn't until the very end where a number of factors relating to demographics, as well as Paul Volcker coming in and jacking up interest rates super high, he basically put the economy into recession in order to stabilize the dollar, the purchasing power. So that's how that decade went. Now, if you go back to the 40s, it was a different environment because most of the inflation was driven by fiscal spending, whereas in the 70s, it was a combination of a lot of things. It was partially fiscal spending. A lot of it was bank loan growth, right? Whereas in the 40s, it was almost entirely gigantic war spending. And so we often think of war spending as foreign spending, but actually most of it is spending on the domestic economy. They're building factories, they're paying for GI bills. A lot of the programs are somewhat similar to what we saw over the past year and a half, but obviously tailored towards more industrial purposes. And so you had this massive increase in the money supply from the fiscal spending, which was monetized by the Fed. And so you had an inflationary component, especially because also every country in the world was trying to get as many commodities as they could, right? So there's a lot of commodity demand. And so you had a very inflationary environment. The difference was that because federal debt as a percentage of GDP was 130%, they could raise interest rates to 5% or 10% or higher because it would bankrupt the government. So they had no choice. They just had to hold interest rates low, despite the fact that inflation was high. And so if you were holding cash or treasuries, you just got annihilated on an inflation adjusted basis for like a 9-year period where they just held rates super low, even though inflation peaked at 19% year over year in the 40s, and the overall average inflation for that decade was about 6%. And you just sat there earning roughly 0% on your T-bills and roughly 2.5% on your longer dated treasury bonds.
So when you look at this, you had a second tweet that basically said this is the widest gap that we've had on record, and you'd have to go back to the 40s and kind of the situation you're talking about there. Is your thought process that we now are entering the exact same situation where they're going to have to keep the rates low for a decade or so, and we can look to the 40s as the actual guide for what to expect moving forward? Or do you think there's some similarities, but we may get kind of a different outcome or a different action? One, they obviously have the hindsight of what happened in the 40s and the 70s, but also they may have some different thoughts in terms of what to do moving forward.
So I find that the 40s is the most instructive analogy to be familiar with. Basically, I would say it's not going to be identical to that. There are differences that I can go over, but anyone who's not familiar with the 40s is going to be in for a rough time, I think, and confused about markets. And so it's a useful period to study in terms of fiscal monetary policy. So I would say in those areas, fiscal monetary policy, it's likely to be very similar to the 1940s. There are some differences, and so obviously there's a different geopolitical environment. We're not in a world war. Instead, there's basically spending related to lockdown things and basically fiscal stimulus in that regard. So there's still kind of similar fiscal environment, but it's for different purposes. There's very different demographics in the developed world, right? So you have a much older population, and so some of these structural deficits aren't really going to go away anytime soon. Whereas at the end of World War II, they were able to eventually get their deficit away, at least for several years. And so there's differences there. And another difference is that the United States back then was a creditor nation and a trade surplus nation. So we were like a rising power. We were producing more than we were importing, and we owned more foreign assets than foreigners owned of our assets. Whereas in this period, the United States is the world's biggest debtor nation, where you have a structural trade deficit. So in some ways, we actually look more like the United Kingdom looked in the 1940s, meaning that they were the existing kind of world reserve currency. They were the ones running structural trade deficits. And the United States was kind of like the China back then. They were the one that was coming up with massive GDP growth. They were the ones, making things for the world. And so the roles are somewhat flipped here. So there are important differences to be aware of. I think one final difference is that in terms of the equity market, it's a pretty different environment because we went into the 40s, equity valuations were very low. You just came out of the 1930s depressionary period. And then obviously the beginning of the war years were not going very well. So basically until there were major victories in the Pacific, equities were very, very low valued. And they started to rise after that when you had these inflationary pressures. And when it became increasingly obvious that the United States was going to win the war, and that things were going to go, pretty well at the end. And so going into this environment, obviously it's very high equity valuations. And in many ways, that actually does look closer to the 70s because you had very, very high valuations in the late 60s, early 70s going into that inflationary period. And so that can certainly affect how equities perform on an inflation-adjusted basis between these two environments.